Hello everyone, this is Dr. Zhao at MTSU. In this video, let's discuss some very typical bond portfolio management strategies. And in the bond investment area, I can say that there are hundreds, maybe thousands, different types of portfolio management strategies. But we can put all those strategies into two very basic categories. The first one is passive bond management, and the second one is active bond management. And those two different investment styles reflect money managers' different assumptions about market efficiency. And if money manager believe that the market is pretty efficient, in that case, they assume that market expectations are always right. And in order to thrive on this bond market, it's better to follow the market index. So the practice here is that bond portfolio manager need to set a bond portfolio risk profile identical to the bond market benchmarks risk profile, so that passively managed bond portfolio will generate the exact same return as the benchmark bond market index. So this is a very typical passive bond management. Right? And they assume that managers are not smarter than the market, and the best way for them to earn decent return is simply follow the market. And the second strategy is active bond management. And here, money manager believe that market is not completely efficient. And the bond price can be undervalued or overvalued. And this strategy assumes that the managers have superior expertise in forecasting interest rate risk and credit valuation. And they can always find mispriced bond due to the very different interest rate forecasting and forecasting on the credit conditions of a typical bond. So what they needed to do is look at those misvalued fixed income securities and build a portfolio that contains either undervalued or overvalued bonds in their portfolio. And their goal is to outperform the benchmark index return. Now let's take a look at some very typical passive bond management strategy. And a very famous strategy that the bond managers are using nowadays is called immunization strategy. Immunization strategy is a very useful strategy for bond portfolio manager to serve their clients, such as insurance companies or pension plans. Now let's take a look at this table. Let's say this is an insurance company, and here you see a very simple balance sheet for the insurance company. On the left you see assets, on the right you see liabilities, and here insurance companies what the insurance company does is they take premiums from their customers, right? But in the future they need to deal with all the claims from the pool of their clients. So when they receive premiums, what do? They invest. They invest the money that we receive from the investor. Where do they invest? It's very unlikely that insurance company will take a lot of risk by investing in stock market. But it's very common for them to invest in bond market, because bond market is, generally speaking, safer than the stock market. And on the asset side, you will see insurance companies typically will build a bond portfolio, and on the liability side, insurance company need to deal with future claims from their customers, right? And you can view all those liabilities as a portfolio of bond that is sold to their customers, right? And so here you can, from the balance sheet perspective, you can say that, okay, on the asset side, they purchase bond, building a bond portfolio. On the asset side, they buy bonds, right? But on the liability side, they issue bonds, and all those claims can be viewed as a portfolio of bond that they sell to their customers. And here you know that, okay, bond value will change due to interest rate changes. Let's say when interest rate increases, well, the value of bond portfolio on the asset side will increase. And also the liability will increase, which means they need to pay more money, right? When interest rate is declining. So the problem here is if duration of liability and assets are mismatched, company may suffer from huge losses due to interest rate risk, right? And so a smarter strategy here is find a way to immunize insurance companies' operation from any attack from interest rate changes. So here you have three scenarios. First scenario, interest rate equal to 8%, and the value of bond assets and the liabilities are all equal to $10,000. Right? And second scenario B here, interest rate declines. Right? When interest rate declines, you know the bond value will increase, and here bond value increase on the asset side to 10,476, and also on the liability side, bond value will increase to 10,476, and here since both sides increase, and the net change is equal to 0. And in the case of C, interest rate actually increased by 9%. All right, that's bad news for bond, especially on asset side. But don't worry, the liability will decline as assets. And in this case, although bond value all declines, but there is no net effect on the insurance company. So in this case, the insurance company is fully protected from any interest rate changes. And in order to implement this immunization strategy, what the manager needed to do is make sure, first of all, the duration of bond portfolio on the asset side and the duration of liabilities equal to each other. You have to equalize or match the duration of assets and liabilities. That's the first thing that you needed to do. And the second thing is to make sure that net present values, the total value of your bond portfolios on asset side and on liability side equal to each other. Once you implement those two measures, then you can have a peace of mind as the insurance company's owner, because you know that, okay, right now your insurance company operation is fully protected by this immunization strategy. No matter how crazy the interest rate will be in the future, you don't need to worry about anything, because the net change due to bond price change for your company is equal to 0. Right, so this is a very, very useful strategy, especially for insurance companies and the pension plan. In addition to duration match strategy, also called immunization strategies, company like insurance companies, pension plan also need to follow another strategy called cash flow matching strategy, because in this case they want to make sure that the cash flow generated from the bond portfolio can deal with the future claims from their clients, and they don't want to mismatch the timing of cash flow, because mismatch of timing of cash flow can lead to huge problem for a typical insurance company or pension plan. So here, in addition to duration match, both insurance company and pension plan needed to find a way to match the cash flow from the fixed income portfolio on the asset side with those of obligations. And deduction strategy is simply the multi-period cash flow matching strategy for those institutions. So here we have several important strategies that bond manager can utilize to assist the operation of insurance companies or pension plans. Now let's switch our focus a little bit towards active bond management. And in this category, bond manager trying to outperform the market. They want to earn higher return than the benchmark index. And only thing they can do is to find those misvalued securities, misvalued fixed income securities, right? Based on their unique capability to forecast changes in interest rates and changes in credit conditions for a typical corporate bond. And in this area, you may find a couple dozen, 100, or even 1,000 different types of strategies. But we can put those strategies into 5 basic categories. First one is substitution swap. Substitution swap. And here you simply exchange one bond for bond with similar attributes, but with a better price. Right? The reason why you call it a better price is because you found a bond is undervalued. Let's say bond A and B. They are essentially identical in terms of attributes. They have the same interest rate risk, similar term to maturity, similar coupon rate, exact the same initial yield, and also those two bonds have similar credit risk. But here you found bond B is undervalued than bond A. Therefore, you want to exchange A with B to achieve higher return. That is substitution swap. Intermarket swap refers to the practice where money manager actually switch from one segment of bond market to the other. Let's say right now you have tremendous investment in treasury securities, and based on your forecast that interest rate is going to go up. Therefore, you want to move your investment from treasury securities to corporate bonds. And on the corporate bond sector, of course, higher interest rate will depress bond price, but due to the booming economy, you see that credit risk will be improved significantly for corporate bonds. Therefore, you can switch treasury bonds with corporate bonds in order to achieve higher returns for your investments. Rate anticipation swap is based on the forecast of interest rate. Right now, let's say you forecast that interest rate is going to go down. And you have a portfolio of bond that has short term to maturity. Those are short-term bonds. Term to maturity range from 1 to 3 years. But right now, you forecast that interest rate is going to go down. Therefore, in the future, bond price is going to go up. But in order to maximize the gains due to interest rate decline, you want to increase the duration of your bond portfolio. And you want to switch your current short-term bonds with longer-term bonds, because when you hold the longer-term bonds, duration is higher. And when interest rate declines, you can maximize your bond investment return. That is a rate anticipation swap. It's based on your forecast of interest rates. And the fourth type of bond strategy is called a pure yield pickup strategy. A pure yield pickup swap or stress swap means you exchange bonds and actually you want to pick up higher yield. And actually you simply move your investment with low yield bond to high yield bond, right? And I mean, of course, you need to bear more risk. You need to bear more risk by moving your bonds from a low return area to higher return area, and typically involves switching short-term bonds into longer-term bonds and switching bond with lower credit risk to those have higher credit risk, so you can pick up higher yield. That is a pure yield pickup swap. And tax swap refers to a strategy where you swap in two similar bonds to receive tax benefits. And the typical example is municipal bonds. And municipal bonds do not have tax liabilities from the federal level. And sometimes you want to switch your corporate bonds into municipal bonds to enjoy the tax benefits. That is a typical example for tax swap. And a very useful tool that bond portfolio manager utilize to forecast future bond price change is so-called horizontal analysis. And horizontal analysis simply look at bond price changes based on certain amount of interest rate change. Right? So essentially, you want to calculate your future bond return based on your forecasted interest rate change. So in conducting a horizontal analysis, first thing that you need to do is look at future interest rate changes. Let's say interest rate will increase by 1 percentage point. Then you look at how bond price will change for the next year, and combining the bond coupon payment to calculate the future year total return, which combines both capital gains and coupon income. That is a horizontal analysis. And for active bond manager, they assume they are smarter than market. Right? They have a superior capability in forecasting interest rates and credit condition, but you need to be careful if you decide to manage your bond portfolio actively. Right? And there are a lot of lessons that the professional learned during the last 100 years also. First lesson is they need to respect the market price. They need to respect the market price. And market price sometimes is the best estimation of intrinsic value of any bonds, because the market, generally speaking, is pretty efficient. Right? And all the participants on the bond market are equally smart. And it's really hard to beat the market. And to have a true investment value, to have a true investment value for your active bond strategy, you want to make sure any information that you utilize to forecast the interest rates, to forecast the level of credit risk, is something that has not been reflected in the current bond price. You should have some actual thing that other people don't know in order to beat the market, right? And let's say you now forecast that interest rate will increase by 1%. Of course, you want to reduce your bond investment position, right? But it's more likely that everybody else already know this, right? And the bond price already declined to a certain level that leaves you no room for potential profits. So in that case, information that you know and know to other people is already incorporated in the bond price. If you trade according to that, then there will be no gains. And a lot of people have confidence that they can forecast the interest rate, but interest rate movement is extremely hard to predict. So those are lessons that past money managers learned during for their bond portfolio management. And if you decide to go on for the active management strategy, then you need to be very, very careful. Right, so that is Chapter 11, Bond Portfolio Management. Let's spend a little time to look at those homework questions. Chapter 11, Managing Bond Portfolio. First, bonds rated at what level by a Standard & Poor's are considered investment grade. And here, the answer is BBB. Any bond that has rating higher than BBB are considered as investment grade bonds. Those are good bonds with a great quality, which means they carries lower amount of default risk, and those bonds tend to deliver lower rate of return. Number two, you found a 5-year XX Xerox bond, XX or AA Xerox bond price to yield 6%. You also found a similar risk 5-year Canon bond price to yield 6.5%. If you expect interest rates to increase, which of the following should you do? So, okay, you have two bonds. They have similar default risk and exactly the same term to maturity. So you would expect that those two bonds to generate exactly the same return, but Canon bond offers higher return and Xerox offer lower return. And here, what you can do here is capture the relative value, and you wanted to buy the bond that has higher yield and short sell the bond that has lower yield to capture the relative value. So the best strategy here is B, buy Canon bond and short Xerox bond, because those are two essentially identical securities, but Canon bond is cheaper than Xerox bond, and you can do arbitrage. Number 3, a forecast of bond return based largely on prediction of yield curve at the end of investment horizon is called, okay, this is called a horizontal analysis or horizontal analysis. And the answer is D. For number 4, a portfolio manager believes interest rates will drop. Well, drop, that's good news. Bond price will increase. And decide to sell short duration bonds and buy long duration bonds. This is an example of what swap. What is swap? And here you believe, right? You forecast that interest rate will drop, therefore bond price will increase, and actually you want to maximize again by having bonds that has higher duration, because bond price will increase more. So this is a very typical rate anticipation swap. B. Number 5, you own a bond that has duration of 6 years. Interest rates are currently 7%, but you believe that Federal Reserve is going to increase interest rate by 25 basis points. Okay, what is basis points? Basis points is 1/100%, and 25 basis points means 1/4%. And you predicted price change on this bond is equal to what? And here you simply applies the concept of duration. Right? Interest rate is going to increase by 1/4%. So changing interest rate is 1/4%. You time that with duration. Duration 6. But here you need to be careful, because the exact change in the bond price, to get the exact change in bond price, you needed to use modified duration. Modified duration equals duration divided by 1 plus the interest rate of 7%. So here modified duration equal 5.6, and you time this 5.6 with interest rate change a 1/4%, and put a minus sign here, you get a negative 1.4% change in bond price, which means when interest rate increase by 1/4%, bond price is going to decline by about 1.4% for this bond. Answer is B. Number 6, a bank has average duration of its liabilities equal to 2 years, and the bank's average duration for assets is 3.5 years. The bank's market value of equity is at risk if interest rate increase or decline. So here, the durations are mismatched, right? And this bank is not protected from any interest rate changes. But you really want to know what kind of interest rate change will lead to losses for this bank, right? So let's say interest rate increase. What will happen to the bond portfolio? Bond portfolio will decline, right? And duration of asset 3.5, which means bond value will decline by negative 3.5%, but the liability only decline by 2%, right? Liability only decline by 2%. When interest rate increases, bond value interest rate increase, bond value will decline, and here you have bigger decline on asset than liabilities, which will have negative effect on your equity. Therefore, your bank assets is under risk or at risk if interest rate increases. And if you apply a scenario where interest rate falls, you will see that, okay, if interest rate falls, then the assets will increase by 3.5%, but liability only increase by 2%. And here, it adds value to your equity, right? So overall, if you have higher duration on asset than liability, then the company's operation is at risk, especially when interest rate is increasing. So the answer is C. This is a pretty harder question for you to deal with, and you need to look at visualize the structure of the balance sheet to see how bond price changes if durations are mismatched. Number 7, banks and other financial institutions can best manage interest rate risk by doing what? Well, here, immunization strategy. Immunization strategy require them to match the duration of the assets and the liabilities. So answer C. Number 8, bond portfolio immunization strategies, techniques balance what two types of risk, and actually the bond portfolio immunization strategy balance or equalize the bond price risk and reinvestment risk. Bond price risk and reinvestment risk. When those two risks cancel off each other, it leaves zero risk. It leaves zero risk for insurance company or for pension fund. Number 9, the exchange of one bond for a bond that has similar attributes but it is more attractively priced is called, this is simply a substitution swap. Number 10, a bond swap made in response to forecast of interest rate change is called, rate anticipation swap. Number 11, a portfolio manager sells T bonds and buy copy bonds because the spread between Treasury and T bond yield is higher than its historical average. And this is the example of what? Well, investors move their bonds from Treasury securities to copy bonds. Of course, this is intermarket swap or intermarket spread swap, because investor can get higher return on Treasury bonds because due to the increasing spread between Treasury securities and copy bonds. Number 12, in a pure yield pickup swap, what bonds are exchanged for what kind of bonds? Right? If you want to pick up a higher yield, you have to bear more risk. Bear more risk means bond portfolio should have higher duration. So answer here is B. You move from shorter duration bonds to longer duration bonds in order to pick up actual returns. Answer is B for number 12. Number 13. And number 13 shows the example of horizontal analysis. A 20-year maturity bond pays the interest of $90 once a year and has a face value $1,000. Year 2 maturity 10%. You expect that interest rate will decline over the upcoming years. Decline means bond price will increase, right? And the year 2 maturity on this bond will be only 8% a year from now. Using horizontal analysis, the return you expect to earn by holding this bond over the next year equal to what? Well, so here you need to look at two different types of income you will get from this bond. First one is coupon, $90, right? And the second one is potential capital gains when bond price increases. Because right now, the year to maturity is 10%, and you know that in 1 year, their numbers will decline to 8%. All right, declining interest rate is good news because the bond price will increase. Right? And here you wanted to first of all calculate initial bond price. Initial bond price. You can use calculator. Use a second row of your Texas BA2 calculator to calculate bond price. Right? And on the second row you see N. That is a number of years or number of coupons. In this case, equals 20. IY is the interest rate, and initial year to maturity is 10. So this IY equal 10. And the PMT is equivalent to coupon payment. And here coupon payment is $90. So you put the 90 as PMT, and the future value always equal to 1,000. Then you compute the present value, which is the bond price, and it will show you negative 914.86. That means bond price is $914.86. Now, you change the variable on your calculator to calculate bond price next year. So next year, the interest rate will decline from 10% to 8%. So you here change IY from 10 to 8. And also you need to change number of years, because 1 year later, the time left in your bond will decline from 20 years to 19 years. So this N should be 19. Then you calculate the present value, and it will show you 1096 as new bond price. That's a future bond price, which is higher than current bond price. Then you take the difference to get so-called a capital gain from holding this bond, right? And then you combine the capital gain with your coupon income, $90. That is your total gain, and divide your total gain with initial bond price. You get total return for the next year. And the answer is 29.6%. Number 14, the historical yield spread between AA bond and AAA bond has been 25 basis points. Currently, the spread is only 9 basis points. If you believe spread will soon return to historical level, what should you do? Right, so here, AA bond is riskier, right? So AA bond earn higher return, and right now it earns 9 basis points higher. But in the future, you believe that it will make more money. So here it seems that AA is undervalued and AAA is overvalued. And in order to capture the maximum amount of return, what you needed to do is to buy AAA bond and short AA bond. Answer is C. Wait a second, let me see. I think yeah, C is not correct in this case. C is not correct. It should be the opposite, because right now spread is 9 basis points, which means AA bond is under. Let me see. AA bond is higher than AAA, but not as high as supposed to be. So AA is undervalued. You should buy AA and short sell AAA. So A is best answer. A is the best answer. Right, for number 14. Number 15. Market economists all predict a rise in interest rates, and a smart bond investor wishing to maximize her capital gain might employ which strategy? Right? So higher interest rate means lower bond price, and you want to minimize the losses on your bond investment by switching from high duration bonds to low duration bonds. So B is the best answer. Number 16. What a strategy might an insurance company employ to issue that it will be able to meet the obligation of annuity holders? You say, hey, immunization. Well, immunization doesn't make sure that will happen, because here insurance company need to match cash flows in order to meet the obligation of annuity holders. So the answer is A, cash flow matching.